Hi, I'm Fred Ruffy with Trade Alert. I'm here at the CME group on the floor for Traders Exclusive. Today I'm going to talk about the recent challenges that we face in this low implied volatility environment and a quick preview of Apple earnings and what we can expect in terms of volatility. Right now, as you probably are aware, VIX is around 12.5, falling to 5-year lows. VIX is a measure of S&P 500 implied volatility. It's based off of a strip of shorter term options, and the decline has been significant since late December. VIX was around 22.7 on December 28th and fell all the way down to 12.5 roughly, 5-year lows. So that's a trend we've seen throughout the market. Yesterday we counted almost 300 different stocks that have implied volatility at 52-week lows and about 120 exchange traded funds. And that is interestingly includes a lot of the commodity funds, which you might expect to see more volatility because they're not always correlated with the stock market. But for example, GLD, the gold ETF, has implied volatility right now, 30-day implied volatility of only 11%. And that's very low. That's a 52-week low. It's at the low end of the range. And so when you see low implied volatility, that sometimes will motivate us to look at buying opportunities. Because when implied volatility is low, that means options are relatively cheap, the premiums are less, and there's less risk from time decay, which is always a factor when you're buying premium. The important thing to keep in mind when you're looking at implied volatility today, while it's low across a large number of stocks and ETFs, the term structure remains very steep. And what that means is that while the short-term implied volatilities like VIX or like the 30-day implied volatilities in GLD are low, if you go further out in different expiration months, then implied volatility increases. And this so-called steepness in the term structure of implied volatility across the market today means that we have an important challenge, because while we might want to buy the slow implied volatility in the market today, it's in the front month, and those also see the greatest amount of time decay. So when looking at opportunities, we want to be somewhere in that middle range, not going all the way out to January 2014, but also not in the very short term. Now, Apple is a different animal altogether because its term structure is steep, but in the other direction. The implied volatility in the short-term options are very high, and that's because Apple has not been moving along with the broader market, whereas the S&P 500 is moving to 5-year highs. Apple has been falling since mid-September from over $700 to under $500. So the implied volatility in Apple has been moving up in the short-term options, and that also has to do with the earnings. So a final thing to look at when we're looking at Apple heading into earnings is that the implied volatility in the short-term options is very high heading into the earnings report. And what we're likely to see is once this so-called event risk, earnings event risk has passed, implied volatility will come down. Right now, the January straddle that will expire at the end of this week, so it will have 2 days of life remaining after Apple reports earnings, is the at-the-money straddle, 5-10 straddle, is trading for $35 right now. And the February 5-10 straddle is about $48, and the March straddle is $56. So after the earnings report, watch those prices, because it's likely that the short-term, these very near-term weekly options will see the greatest contraction in implied volatility. Apple has seen an average daily move after earnings of almost 4%. Right now, the weekly straddle is trading about 6.7%. Our models suggest maybe an even larger move tomorrow, but it wouldn't take a substantial, very substantial move higher or lower for that straddle to make money before the expiration. And so keep an eye on that. The weekly 5-10 straddle trading for $35, the February 5-10 straddle right now at $48, and the March straddle at $56. my guess is, unless there's a very explosive move, that March straddle will hold up better than the others. So that's something to look at, a little lesson in implied volatility. It's an interesting time with implied volatility's 5-year lows. There's still a lot of opportunities, different sector plays, energies, technologies, financials. We'll have more to you in coming days from Traders Exclusive. Thanks for tuning in. I'm Fred Ruffy.